So could rate cuts be the catalyst to help the rally avoid the September effect? We have Olaolu Aganga. She is the U.S. Chief Investment Officer at Mercer. Good to see you here this morning. You just heard Brad and I talking a little bit about the state of the consumer. Does the consumer have an out? Like, when do things get better?
You know, as we start looking at just even the events of this year, so finally we had the Jackson Hole speech, right? It's time for policy to adjust. It's really indicated that the odds are there will be a September rate cut. It's about time. Now, if you think of the Goldilocks moment, so it's not quite too hot, not quite too cold, it's trying to bring it down. We expect rate cuts to happen 25 basis points each of the next few meetings in a more gradual format. Now, yes, there is some pain with the consumer, but this is expected. The goal was to slow things down a bit and bring inflation lower, and we're starting to see that. So it's not unexpected.
It's a consumer that's navigating so many different events right now, and as of right now, within this University of Michigan survey here, consumers' short and long-run economic outlook both improved here. Yeah. But as you're kind of looking out to the rest of the events that the consumer is going to have to navigate, elections has been one of them. That played out in this report as well here. Yep. What is the catalyst for consumers to make them feel more comfortable than they are right now?
So at the end of the day, we have policymakers in place that are stabilizing the overall economy and the markets. There are three main things. So if you start, again, as I mentioned, the Fed, they're monitoring rates. That feeds into mortgage rates, lending rates, the average things that you see. They had to bring it down from a consumer standpoint. That's number one. Then the next thing, if you think from a consumer standpoint, and just the overall economy, is all the volatility and maybe geopolitics that could be slightly destabilizing, either from a macro standpoint or elections. Now, elections could be nerve-wracking because it brings uncertainty, but at the end of the day, with the three branches of government, you need all types of alignment, so many things need to happen there.
We had another economist on in the other hour, and their base case for GDP next year was 1.5%. That really took me by surprise, because if we're getting rate cuts, shouldn't the economy be growing faster than that?
So we are in a situation whereby the economy has been strong. That, that's a little bit of an outlierish type view, and you're surprised, we're surprised. For us, we view this as a very moderated process to occur. I would be surprised if you saw any big gaps. Right now, even Jerome Powell indicated strength across a number of areas, but did actually talk a little bit more about the unemployment and labor picture. So that was a focus. Unless that falls apart or it becomes a little bit more acute, our view is more measured than that.
What are the sectors right now that investors can feel comfortable dipping their toes in or adding on to their positions, even knowing what the consumer strength is looking like, especially across cohorts that are feeling the pressure a little bit more and those that are trading into lower priced options as well?
So at Mercer overall, we look more from a broader asset allocation standpoint rather than sectors. However, even if you were to look at some of the bigger themes, we know the direction of rates is lower. Mm-hmm. This summer alone, you saw the sectors that did pretty well were those that were linked to rates. So REITs we saw, financials we saw, clearly healthcare has something more to do with potential elections and some of those focuses. But I would say where you're seeing bigger moves, so what would benefit from a rates lower type of environment. And then the other areas are some of the bigger things with regards to policy, so infrastructure and where you're seeing political dollars go into.
Is this a market that is just too obsessed with every move or comment on NVIDIA?
Yes.
I mean, there's a bunch of other stocks out there.
You didn't even finish it.
Right? Do you get people, there's other things to buy, right?
I started my career, over 20 years ago, and I was on a trading desk, and it was minute by minute, right? Like minute by minute, that's all you think about. And then you realize that if you you start on Monday, minute by minute, you go on Friday, just do nothing, you've circled right back, right? That's what happens. So we typically say, just pause. Just like the volatility we saw 3 weeks ago, when there was a big drawdown, dissipate in a few days.
Can the market work higher if NVIDIA is not working and going up and to the right?
Right now we're saying NVIDIA. Last year it was 7 stocks, right? So it's moved from the magnificent 7 headlines all the time to the 6, right? And now it's just the one. we'll change out the name pretty soon.
You know, as we're looking for a changing of the name and looking for whatever the thesis or whatever the major theme is that prevails next, you know, how do you best anticipate the theme if we're moving from AI into the next major thing that companies are going to talk about? I mean, one year it's NFTs, one year it's blockchain, this year it's generative AI, and that being the next kind of iPhone moment. How do you best anticipate something like that if you're an investor?
So, and that's where we spend a good amount of our time. So what are the long-term trends and themes? Now, technology as a big block has been a very, very big driver, 10, 15 years, right? And as a result, pushed up growth stocks. Within technology, it's where people are spending money. Where's the CapEx? Right now, it's AI and generative AI, and that popped, maybe start of the year, last year, right? It was a big focus. But we tend to look at where the investment dollars are going. So for the companies themselves, you know, within equities, what are they developing? Tech right now is where there's been a lot of spend, and it's been, you know, varying within that.
Brad, well, I actually started buying Starbucks shares when I started drinking coffee at 10.
Really?
No, I'm just kidding. Absolutely not. I don't own Starbucks shares.
You
Did not do that.
drinking coffee well before 10 o'clock.
Do that.
You start at 10 p.m. the night before.
Yes,
what I believe.
no comment.
Olaolu Aganga, who is the Mercer U.S. Chief Investment Officer. Great to have you here with us.
Thank you for having me.
Good to see you.